Good evening, guys. Ken at Tortoise Capital, nightly strategy podcast for July 2nd, 2022. It's a weekend swing trade framing and looking at our sectors. Here we go. All right, let's start with Chi Weng Chong's RL30 slope, the Z-score of the sectors. Again, so this is, we're looking at Z-scores. And so the idea of the 30 period slope is something like this. So we got some new folks in here tonight. So you take 30 bars and you find the regression line, the RL30. That's the best fit line for all that data. It's the one that minimizes the distance, the error from the regression line. So it's the best single straight line description of that price trend. If that price was perfectly sideways, then the slope line would be zero, be flat, but this one is slightly up. So that angle alpha has a degree. It has a certain steepness. If that price was like this, then that angle would be better. And so we would prefer trend A to trend B. And because it's that much better than B, and B is that much better than zero. So now we can compute that value, that slope value. You know, that's the M is the value in the formula Y equals MX plus B. That gives you the slope value of a line. And so what we want to do is we can compute the slope value every day for the last 180 days. And we can find out what that value is. And then we can find the maximum, the min, the average, and then the standard deviation. And that would let us know something like, +1 and -1 standard deviation. And that would give us something like, in the Army, we would call that a range fan. That would tell you, imagine you had a little indicator, and you could see how that thing varied between the maximum and the minimum. And then you could compute the Z-score of each of these daily lines. And you can take today's slope value, compare it to those last 180 days, compute the Z-score, and then you would know within its performance how good or bad it was relative to its own performance over the last 180 days. And then if you plotted a time series on that, you could see how that slope value was varying through time, and you'd see something like the very smoothed price trend of each 30-day segment going back 180 days. You could then compare the sectors against the broad market itself, and then see the relative strength of the individual component sectors of the S&P against the S&P itself. And by plotting all of that on a Z-score scale and finding the average, this is when the slope is positive, and this is when the slope is negative, you get something like a rapid array of the cycle of sectors and the markets through time on a relative basis. And because these are Z-scores, you know that most of the data falls between +1 and -1. So about 1/3 of the time, that data is in that band right there, right? And only 1/6 of the time does it get beyond that. So anything more than plus or minus 1 becomes an abnormal condition. Abnormal compared to itself over the last 180 days. See, how unusual is it compared to its own history? So that's the basic idea, is to find where the strong and weak sectors are. And now what you can see is that the S&P acts, and this thick purple line acts in the middle, and you can see how strongly it attracts most of the other sectors, and it is kind of in the middle and all the way. And the lone exception happens to be energy. And part of that reason is that as war in Ukraine is ebbing and flowing, energy is acting on its own accord because it has been experiencing extraordinarily abnormal price pressure. And you saw a tremendous rise in the price of oil, and then a decay in the energy sector as prices reduced a little bit, and we're coming under pressure for their excess profits. And now there's sort of more global risk. And XLE has had extraordinary pressure. Now, one of the ways to use this is to know which sector, like back here when the market was suffering, but energy investments were really working. You could gain an advantage by emphasizing your exposure to energy. When it gets past +1, though, you got to be really careful, because now you are in abnormal conditions, and it's hard for an entire sector to remain up there. So when that thing rolled over here, there was an indication that perhaps the abnormal expectations were over, and there was a chance of a reversion to the mean. So when you see those kind of turning points, you can act accordingly to preserve whatever profits you made on the way up. Well, not only do things exceed expectations in abnormal, but when they come back to the mean, it's not unusual to see them overshoot that. So you get this oscillating effect, not just in energy, but in all these. And now you see energy down here at -3.5 sigma. That's how much has come out of the energy sector on a price basis. 3.5 standard deviations of adverse move. That's a 5.5 sigma move to the downside, which is kind of extraordinary. So if you take a look at all of the energy stocks, you'll see exactly that kind of roller coaster ride. Well, for short-term traders, this is a godsend. You love trading on the short side in that kind of price decline, because of the increased volatility in the short term is our friend. So you like to know that. So let's see where we are now. So this is our zero line, and we're seeing pain and suffering here in the S&P on this latest leg down, although it did show signs in the last 3 days of making some kind of stability. Tech has been the strongest relative, finance, and then energy's been getting slaughtered, and then the steel companies and the other materials have been suffering as well. So I'm, as a catfish, as a bottom feeder, I'm always interested in deep value. In addition to trading things on the short side on the way down, I also like to see where is the point of maximum disgust, and then where does that become neglect? Much like finance got disgusting here, and then this is evidence of neglect, and now this is an opportunity for value as the rest of the market began to recover. So what this chart shows us then is the relationship between the S&P and then 3 sectors that tend to cycle according to business cycle conditions, quite a bit. And technology, which is sort of the favorite son of the growth crowd, that when the market is doing well, It's not unusual to see tech leading the way to the upside. And even in the first bits of decay, showing some signs of resilience. So I usually think of XLK, the tech sector, as the engine that's pulling the market up the hill towards growth creation. And right. And then I look at finance, materials, and energy as three sectors that can oscillate according to their own battle rhythm. Sometimes one is strong, sometimes the other is strong. Like here, we saw energy was weak, materials were strong. Here we see finance. I'm sorry, that was finance and material. Finance weak, materials strong. Here we see both finance and materials strong. Here we see finance weak, materials strong. So you get this oscillation among those three, and then energy really diverting from the pack and then becoming extraordinarily weak. So it's not unusual to see those three moving out of cycle with respect to each other, conditioned by the S&P, but then also during good times to see tech taking the lead to the upside. So kind of use this as a market segment, market cycling radar screen in that sense. What makes materials so useful is that it is such a small segment of the S&P that a little bit of price action in there can really move it around a lot, because there's not as many companies as there are in market cap as there are in tech. So that's where, so having said that, this is how I'm reading where we are now, is this initial recovery off the bottom has suffered over the last 30 days. The last 3 days have given us a little bit of hope for redemption, but it's really in a critical state as it comes to -1. So that puts this in a compounded critical state where a move back to 0 and then +1 would be seen as a favorable, almost like a Kata 2 condition with higher lows. But at the same time, if it can't hold the stability of the last 3 days, a return to pain and suffering on the next leg down in the market would not be unusual. So that makes this a compounded critical state, perfect for short-term traders. The fact that we're in bearish normal and it's at a critical turning point where it's radioactive is really an important moment. It would not be surprising to see tech lead the way. It would not be surprising to see energy begin to stabilize and recover. So I'll be watching for that. And we'll be looking to see who the next, either the leaders up or the leaders down might be. This is the same concept, only now what we're doing is taking a slightly different approach. And what we're looking at is XLY is the consumer discretionary. This one happens to have, I think it's Amazon, Home Depot, and Tesla in it. And then XLP is all the staples. That's kind of your Walmarts and things like that. And we might think of discretionary as more growth oriented and staples as a defensive play. And so we're taking a look at these two broad market conditions. When XLP is greater than XLY, we see how it acts, and the market begins to roll over here, and then the market, and then all of the growth oriented guys are getting slaughtered. But on a relative basis, the staples are able to hold on to their value as conservative plays a little bit longer, and then they are slower to decline. Like they don't get back to the 0 line until here, their long-term average, while the market and the growth guys got murdered down to -2. But this is where the market began to stabilize, and then money began to flow back into the market and then into XLY. And then that began to rise as P began to fall. And so this was a growth portion of the market cycle, when the market and discretionary began to accelerate while XLP was slow to recover. People were chasing the growth. But then when the market peaks and this rolls over, now you can see that that's a time when XLP comes back into its own, when people try to hold, they want that conservative gains, while XLY is threatening to roll over. So once again, we're right at this crucial moment at Z-1, which is the boundary between normal and abnormal, that if the S&P fails here, it wouldn't be surprising to see that the gains that were made in Y get sacrificed to the gods, and then that begins to fail while XLP continues to get back to normal. So this is another piece of evidence that supports the hypothesis that we are at a really important turning point, a critical state in market condition here. You saw me talk about that last night on the nightly strategy. So that's where we are in terms of the sector. So really good work from Chi-Wing Chong, and really grateful to him for sharing this out. Okay. Any questions on that? Let me know in chat if you found that to be helpful. Otherwise, moving on.